Today, folks, TD Bank just became one of the best performing Canadian dividend stocks of 2025, rising the entire financial sector with it because they are now selling their stake of Charles Schwab, one of the largest US banks. They're liquidating a 10% position to basically focus on the Canadian economy after they've gone through the monopolistic fines. They're getting asset capped in the United States. It's clearly this positioning is really bolstering and making investors feel better. So let's talk about it on the back of this rockier Canadian economy. If you are on a path to financial independence, if you damn well one day want to retire early, join me on that journey by hitting that subscribe button, because TD shareholders, people in our chat group, are incredibly excited here, right? So I'm going to dive into this with, first and foremost, they are selling their entire 10.1% stake. They currently own 184 million shares of Charles Schwab, representing that massive position. Schwab agreed to purchase basically 1.5 million worth of its shares from TD on condition on the completion of an offering, because they're going to do basically a registered offering and a share purchase agreement to pull this off, because obviously this would absolutely rattle Charles Schwab. I mean, this is not a small bank. They've held a position here since 2020. They've made a very ridiculous return. I mean, it's been a great turn. But look at it, for $154 billion, they own like 15 billion, over 20 billion CAD, right? So they can't just liquidate this. So they're going to do it through some dilution, I think, some share offerings and stuff of that nature. And honestly, what they're going to be doing with that capital is reinvesting 8 billion of it, I believe, right into TD stock. They're going to start rebuying back their shares, which I think is a great idea because TD seems relatively cheap. And then they're going to take the rest of that money and focus on expanding in Canada. There's some quotes here. As part of our strategic review, we have been evaluating capital allocation, and we have made the decision to exit our Schwab investment, coming from the CEO of TD Bank. We are very pleased with the strong return that they've generated since 2020. We are confident that TD's growth opportunities and long-term potential, and we plan to use the balance of the proceeds to further support our customers and clients, drive performance, and accelerate organic growth. This, again, it kind of comes on the back of them being asset capped in the United States after their monopolistic fine for money laundering, which I honestly think happens to all banks, but this wasn't a small piece of money laundering. It was worth hundreds of millions of dollars. So it's no surprise they want to exit the United States, right? Like, let's bring it back home to Canada here, but that might not be the best thing either. The Canadian banking sector as a whole has mostly been flat, offering very nominal to no returns so far for the year outside of the dividends, but we're not really even through the first quarter yet. And I want to talk about kind of the more bleak side of the Canadian economy before I kind of give you a more uprising feeling, because yeah, things aren't the best here right now. First and foremost, what most people are concerned by when it comes to Canadian banks is that about 1.2 million mortgages in Canada are due for renewal in 2025, which is about 85% of them will come in at higher rates than the initial rates they got, which were 1% or lower. And this comes on the back of us already seeing a continued climb in loan loss provisions, especially from TD Bank, right? So I'm confident that the Canadian economy can cushion this kind of a blow, but we're also seeing this on the back of more news coming out that insolvent debtors, average credit card balances top 20,000 in Ontario. And this was a very alarming headline, I'm sure, for a lot of people, as there's been a dramatic rise that tells a troubling story about the financial health of Canadian households. Basically, we're seeing consumers increasingly relying on credit cards, not for discretionary purchases, but to cope with basic living expenses in the face of persistent inflation and higher interest rates. Insolvent debtors in the study owe an average of $60,000 in total unsecured debt. That's up 12.2% from 2023. Increasingly, insolvencies have become a fact of life for the middle-class Ontarians, with more than half, 54% of the clients who filed in 2024 have a take-home of more than $3,000 in income each month, a 6-point rise relative to 2023 and a 14-point increase over 2022. These numbers signal a deterioration in household finances across income levels. When we see this magnitude of increase in credit card debt combined with rising insolvency filings among higher income earners, it's clear that the financial stress is moving up the income ladder. So the middle class in Ontario is wrecked. We already know that because you can't make $3,000 a month and actually afford a home. We're seeing a mass discrepancy between, the wealth gap here in Ontario and Vancouver. This is why it's really important to be a bit malleable and maybe even look at moving provinces or somewhere more affordable. I see Toronto becoming a lot more like New York or San Francisco. It is the hub. Same with Vancouver of Canada. And it's just something that, we're going to have to wake up to, because $3,000 a month, unfortunately, does not seem like enough to survive the absurdist. Even the condo that we live in, to rent it would be around $3,000 a month. So I can't imagine you're living a very comfortable life lifestyle in this insanely expensive city today. But we don't even have these problems. We also have the back of tariffs. Trump continues to want to make Canada the 51st state. He seems to be more focused on expanding the territory of the United States rather than focusing on the problems the U.S. has, which honestly, I wouldn't mind becoming the 51st state if they fixed a lot of problems that Canada has resolved years ago. But that is a political debate for another day. But we are seeing tariffs now on steel and aluminum. He's thinking about tariffing cars, and none of this is probably going to stop or slow down until he gets what he wants or some kind of new agreement that gives the US more overbearing control of our sovereignty here in Canada, but time will truly tell. But this is something else that will affect the banks, because a lot of companies in Canada might have loans from the banks that are now going to have to restructure or deal with some of the increased costs that the U.S. companies are going to pay that might stop them from purchasing here in Canada. That could, again, put stress on employment and a variety of other things. All of this in tandem on the Bank of Canada continuing to likely cut rates this year, as they've been aggressively cutting into this onslaught of mortgage renewals, the troubling economic circumstance with people's credit cards. Like I said, when you read all these headlines, it is a lot of fear mongering, and it could really lead to some detriments in your own portfolio. It is why it is so prevalent to find a strategy where you can remove this noise. For me, it's companies like VDY that upperweight the better Canadian stocks. That is going to probably go through some volatility, but will not stop me from cost averaging for the next 10 or 20 years at least. But it is recognizable that I think value on companies are better in Canada. I don't feel like we're in as much of a bubble as the United States, but at the same time, I think we have just as much, if not more, uncertainty when it comes to the geopolitical factors here. So I love VDY. It gives me the exposures to the banks that I love, like Royal Bank, which is not performing great this year. Bank of Nova Scotia is down 5.8%, reapproaching a 6% dividend yield. Canadian Imperial down 2% with a 4.3% yield after being one of the best performing Canadian banks coming out of its slump, rising almost 75% there. National Bank down 3.7%, usually another one of the best performing banks, slumping into 2025. BMO, only one of the very few outliers, along with TD, that is now up 13% this year. And I think TD has been trading in a slump for the growth that they still have. And I want to talk about this growth real briefly, because we have earnings coming up February 27th. And on those earnings, what I'm going to be looking for is, like I said, these banks need to start actualizing some bottom line income, but they have the risk now of losing some interest return. When we looked at JP Morgan and some of the United States' biggest financial institutions, they have been rising dramatically on the back of higher interest rates, because these banks sit on a lot of cash, and when they can park that cash and make 4 or 5% on high interest income from treasuries or money market funds, it really bolsters their bottom line cash flow. And that's why the stocks are rallying. Canadian banks have not been able to see this bolstering because they've continued to get hurt by a variety of factors, including loan loss provisions on the back of lowering mortgage quality, because as mortgages renew, as interest rates get higher and people's income doesn't really change, it lowers the credit quality of that loan. It puts them more at risk, forcing these banks to increase loan loss provisions, at which we see TD sitting at 1.1, they're putting like over $1 billion aside per quarter right now, which is pretty substantial considering this time last year they were at $800 million and now they're at 1.1. In total, I mean, we've gone from 2.9 billion to 4.2. This really eats into their bottom line, or, it doesn't reflect on the earnings. So we need a real turnaround in this. And it's kind of annoying because now we're getting lower interest rates, which means lower interest income. TD will be one of the most interesting, especially after selling or working on selling Charles Schwab. I imagine they'll capital gain that, and we should see it perhaps come into the earnings that could bolster some excitement, I'm sure, especially with the share buybacks. Now, when it comes to TD in totality, I think what the move they're making is really good for the company. I think buying back an aggressive amount of shares. I mean, if you take a look at TD's value, what is TD trading at? $152 billion as well. $8 billion isn't exactly the smallest. Yeah, I mean, it's a substantial drop in the total bucket of value of the company's market cap. And again, it's going to allow them to focus on scaling in Canada over the US, which is great because I don't think they're asset capped in Canada, at least from my understanding. So a lot of that should play well into the earnings moving forward. Again, they've had great revenue growth from 13.1 billion to 15.5. Their total revenue growth has been exceptional, but again, some of that could be related to interest income and other things. However, I'm sitting here looking at the banks in total saying, look, this is going to be a rather rocky year. We just came out of the very suppressed environment. I like HBNK. I'm showing this ETF over ZEB. I know a lot of people like ZEB, but the problem with ZEB is it comes at a higher expense ratio, whereas HBNK doesn't. But if, I like that ZEB has a longer track record. It shows us more of a chart of the combined banks. Because like Pokemon cards, I do suggest collecting them all because they ebb and flow. And like now with TD and BMO performing better, it's picking up for the lackluster performance of the other banks. But we did luckily come out of that slump, and these stocks did rise pretty substantially. So now we're kind of heading back into what I'm going to call a troubling market, a volatile market, an uncertain market, which typically leads to nobody knows. And I can't gamble or bet on it. I'm not trying to cause uncertainty in this video. I'm just trying to tell you, hey, make sure you have a solid plan. Make sure you know what you're doing if you're cost averaging, and stick to the strategy and try not to get too caught up in the drama that has been unfolding. But congrats to those that have been buying the TD dip and have been holding strong. I think this is well alleviated and well deserved for the value it currently trades at. But I'd love to know what you think in that comment section below.